good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Hiremath. And today along with me is Mubina Kapasi. Thanks for joining in, Mubina. It's great to have you on BNSN as well. Let's get a move on. We have a lot of headlines to get through and a lot has transpired in the last 24 hours. Beginning with the fact that global cues have been pretty strong. I can't remember the last time I woke up and saw the S&P 500 notching a lifetime high. So we've heard that from the Nasdaq. The Dow's doing its own thing, but the S&P really clocking a new high yesterday is what's got the world invigorated. Also, your commodities, oil doing quite well with on OPEC cooperation as well as demand outlook being fairly decent. And then your precious metals also now, gold particularly above 2,000. So the handover, I'd say, was a bit mixed from Asia, but barring that, it was pretty strong. Now on to an ET Now exclusive, a big story of this morning that we need to address. We're also going to be talking about this later on in the show. DBT for electricity subsidy to start in 1 year, so that's a big one. We then also have more power reforms coming in from the cabinet that will be meeting today, mulling some serious power reform. So that'll be all eyes on the power sector and power stocks tomorrow. Then coming to movies, a segment that we haven't spoken about for a while. Seems that movies will now be allowed shortly with strict curbs. So that's keeping PVR and Inox in focus as well as the overall film industry. Then in the spotlight, you have ad growth. So we're all looking for green shoots within the media industry. It seems that Pitch Madison sees 60 to 70% growth in ad spends over H2. We've got some commentary positive coming in from Z Entertainment as well regarding ad spend. So it seems that there's definitely an uptick here. And finally, for me, as far as the headlines go this morning, T Rowe Price, a really prominent name, is hiking its stake in UTI trustee company to 51%. So that's got the mutual fund space in focus as well. But over to you, Mubina, for more insights on the market.
Well, thanks, Varun, for that. Those were, of course, the top stories that we are tracking for you on ET Now. And yes, I guess that strong handover from the US markets is, being reflected, albeit in a smaller manner, back home as well, with the Nifty clawing back above the 11,400 mark. In fact, we are at 11,435, and the Sensex is higher by about 170 odd points. Z Entertainment, the uptick continues over here. It's at least the third straight day of gains being witnessed in the stock. Z Entertainment is higher by 2.7%. Result reaction, of course, being witnessed over there. Just flagging off some of the other big Nifty gainers, GAIL India as well as gaining around 3.5%. So that's in focus. PSUs like SBI, IOC as well as BPCL are among the top gainers. But on the losing side, UPL, Nestle, steel stocks like Tata Steel and JSW Steel are losers, but the quantum of losses over there are quite small. From the broader market, an IRB infra is seeing massive momentum, 14% higher, today in trade. And in fact, if you look at just the slightly longer term chart, in the last 2-3 months, we've seen massive pricing action being witnessed in an IRB infra. Adani Enterprises clocking around 9%, and then Himadri Specialty from the chemical space gaining 12%. On the losing side, Astral Poly, Heidelberg Cement, and Amara Raja Batteries. But again, the losses are quite capped. Very minimum losses. So all in all, the PSU basket is gaining. The realty index as well continues to gain. Yesterday as well, the realty index, stocks like DLF, Suntech Realty were, doing pretty well today. The momentum in the realty index continues. Oil and gas as well, Varun, is the other big gainer.
Right, Mubina, thanks for that really comprehensive market check. It's pretty clear that various pockets are performing. There's no select winner. And like you said yourself, the broader market is seeing a lot more participation. And a lot of the names you brought up this morning are also from the broader market. Coincidentally, Mubina, looking at the stock cloud, we're also seeing a lot of broader market participation this morning. So obviously it's beginning with Z Entertainment in the back of now a CLSA upgrade post those numbers. Targets coming in well above $200 a share. This was just at 150 recently. Then this morning we also have packaging companies entering the stock cloud. That's Cosmo and Polyplex. Brokerage upgrades here as well. Raw material prices have been low and demand has just been flying through the roof. So some really good numbers coming out of Polyplex and expected from Cosmo today. Tata Com, because for March the move has just been insane. 250 to 900 today. Somebody pinch me on that one. Phoenix Mills launching its QIP, so that's why that's in there. India Bulls Real Estate, the merger with Embassy is now pretty much decided. Swap ratios are being announced fairly shortly. PVR and Inox in focus because movie theatres will now be opening up based on what we're hearing. And Reliance Industries based on that medical acquisition they made of a small Chennai-based company for 620 crores. So that's how the stock cloud's shaping up this morning, Mobina.
Okay, well, let's now, on that note, bring on board our guests for today. We have Kunal Bothra joining in on the technicals, as well as Gaurang Shah of Jujit Financial Services. Morning, gentlemen, and Kunal, over to you first. A quick word on the market momentum we are seeing today, as well as, of course, your top picks.
So, good morning, Mubina. I think the momentum is very strong. Almost on a regular basis, we are seeing the Nifty, Bank Nifty scaling up, higher and trying to break above its resistances. I think, of course, the onus of that and the major benefit of that, we see it in the market internals as well, that how the market internals have shaped up. So, just a month out back, we were just about talking very concentrated kind of market, very, very few pockets of stocks only, which are leading from the front. But I think the last 1 month, particularly, a lot of the stocks in sectors have, opened up and, it just about offers a lot of opportunity for short-term traders. And that generally happens when the markets go into a next phase or a next wave of rally. So, with the market breadth opening up higher, the indices have now, confirmed a breakout of its, swing resistances. That's more or less like an added confirmation that the indices could move up higher. And I believe that this trend should continue for at least the near term. Would suggest a couple of buy calls in terms of trading picks. And the first one would be a buy on SBI. Now, it's an interesting chart because SBI till off late was just about hovering around that 200 mark. There was some bullish signals which were emerging every time the stock breaks past about those 200 levels, but didn't result into the stock starting into a new trend. But this time around as well, I believe that there could be a new trend which could be emerging for SBI. And I believe that this new trend should, from a trading perspective, lead to at least a 210, 212 kind of a short-term high. So short-term traders could look at a buy. 210 to 215 could be a target range on SBI and stop loss at 193. The second is about LIC Housing. Now, I've discussed the stock, in the last few editions of Buy Now Sell Now as well, that how the stock is poised for a very strong breakout. It was at 263, 265 zone. The stock has now moved up higher to 218, but I still maintain that stance that LIC Housing should see a strong upside from current levels as well. So I maintain the targets which I had given earlier of 300 and revising the stop loss to almost 265 to 66 zone. So LIC Housing is also the second buy, which I would recommend at current levels.
Right, so it's SBI as well as LIC Housing Finance, which Kunal does pick out, in terms of trading recommendations. Hi, Gaurang. Again, a quick word from you on what we are observing in the equity markets. I mean, we just finished the results season. Not that bad, definitely. Largely, and the commentary as well seems to be pretty okay. Not all gloom and doom. How would you place yourself in the equity markets right now? And more so on the fact that, the broader markets have been seeing a lot of momentum in these last couple of months as we've seen the market pick up. And of course, what would be your top bets right now?
Thank you, Mubina, and morning to all of you. So, from March lows, we have come a long way. Let us be honest to ourselves. And yes, the earnings season that you spoke about, first quarter this financial year, well, a lot of participants, including ourselves to a certain extent, expected it to be a huge disappointment in terms of sectorial performance and, of course, individual stock-specific performance. But if you have to sum up the earnings first quarter this financial year gone by, then yes, like you rightly mentioned, there has been no great disappointments. One or two specific company-specific disappointments could not be ruled out, given the backdrop of environment and the challenges that we were facing and the world was facing. Going forward, as we go into the much more awaited unlocking process, we are into 3.0 unlock, and possibly we'll have more steps taken to lift off the restrictions and coming back to new normal, as we call it. our sense is that markets possibly could consolidate at 11,450, 11,500, just replicating what we did about a week, 10 days back. We were consolidating between 11,250 and 11,350 for a pretty long period of time. Similar consolidation cannot be ruled out, a little bit of profit booking, and consolidation, Mubina, is always healthy for making a base and then taking on to the next move, because that will be a durable one. As investment idea on the fundamental side, we've seen cement sector buzzing for quite some time, and in fact, if you have to reflect upon the thing that you mentioned about first quarter earnings, I think despite being a challenging environment and monsoon season, we've seen offtake quite well. Numbers have been pretty decent. Operational expenses have been brought down. Rationalization has been brought in. Profit margins have been steady, and outlook is quite strong for cement in terms of consumption picking up, both on the reforms done by the government on real estate sector and the spending that is likely to have an uptick. So Ramco Cement is the stock specific idea from a long-term point of view. 780 would be the target. This subject to, of course, earnings improving, the targets get revised upwards. But there is a lot of momentum in this particular counter, and we believe that the company is poised for a decent growth from here on. The next investment idea is from private sector banks, ICICI Bank. Steady set of numbers, great improvement visibility for the next couple of quarters to come by. And all this moratoriums word that was putting in shivers down the spine for the entire banking as well as NBFC, things to be lightening up as we've seen in the numbers and the management commentary. So ICICI Bank would be a great investment idea. 510 would be the target. Both these, Mubina, are of course long-term investment ideas, so you should at least have a year and a half plus kind of a time horizon.
Okay. All right, thanks for that, Gaurang. We're going to come back to our queries because we have an exclusive lined up. Nayantara is going to be breaking a story just shortly. The Narendra Modi government is getting set to roll out a direct benefit transfer scheme for electricity. So hi Nayantara, welcome to the show. What exactly is transpiring at the Power Ministry?
Well, there's an ET Now exclusive. Lots of news coming around the power sector. We've got your big interview with the Union Power Minister, R.K. Singh, as well. First up, watch out for today's cabinet meeting. What we're being told by our sources is that there will be a big proposal which will go through, which will ensure that powers are not out at states like Tamil Nadu as well as Odisha, which are running out of cash. The discoms are running out of money. They need a lifeline. They've hit the credit limit when it comes to borrowing as well as working capital. So you could see the FRBM limit, which is the borrowing limit for discoms, being raised from 25% to 40%. This has been confirmed by the Union Power Minister, R.K. Singh, to ET Now as well. A crucial proposal just to make sure that discoms stay in business, that they can continue to buy power. There are a lot of other big reforms coming in. The biggest one to do with direct benefit transfer scheme. We've all heard about the leakages of subsidy, chori, pilfrages, and trying to put a stop to all of that. In 1 year's time, direct benefit transfer scheme is likely to be rolled out where consumers will directly be paid their subsidy by the state governments into the accounts listed with the discoms. This is going to be a massive reform, a structural reform. We've seen how it has helped the fuel sector, LPG, stopped subsidies, and the plan is to do the exact same for the power sector. We understand that a group of ministers headed by Defence Minister Rajnath Singh, also including Union Home Minister Amit Shah, have blessed the rollout of the direct benefit transfer scheme. The Prime Minister's office is in favour of it. It could be rolled out within 1 year's time. Now, it will create a shocker assault for the states. So the centre, and power is a state subject, so just to build consensus and have states enough time to plan it. Like I said, it could be rolled out in a year's time, but it'll also be done gradually. So it could be done in a graded manner for 5 years' time. Having said that, the plan also is that in this new tariff policy, to just bring down the cost of power, align it with market, and also remove inefficiencies of the discoms. Now, discoms are looking at a situation where their debt is going to hit a lifetime high of 4.5 lakh crore rupees by the end of this financial year. That's 30% higher than the previous financial year. And you've got to make discoms accountable. Right now, that's not happening. So there's going to be penalties in case discoms announce higher load power shedding. There will be disincentives for discoms to not be efficient, but at the same time, there'll be incentives for them to be efficient. So, the center clearly now trying to reform the power sector. You've just seen, increment reforms here and there, but the big bang stuff is now coming in the form of the new tariff policy.
Yeah. All right, thanks for that, Nayantara. Really important story. And all that information is going to be digested, and obviously the various power stocks and discoms might be in focus on the back of that. So keep an eye out for that sector as a whole. We're now going to come back to our queries, so I hope both our guests are still with us. And our first query is from the line of Dilip Verma, and suggests a short-term and long-term horizon for South Indian Bank. So firstly, Kunal, let's come to you first on the chart. Can you even give us a concrete chart opinion on South Indian Bank? And as an investor, an advisor, what do you feel about the Dilip's choice in South Indian Bank? Aren't there a lot of other banks out there that he could perhaps be looking at? I mean, Gaurang just mentioned ICICI. What do you think about South Indian Bank?
Yeah, I think I'll probably echo what Gaurang also said. So I think it's better that you look at stocks like ICICI Bank. See, because on one hand, if you expect that, and I for one expect that Bank Nifty should move up significantly higher from current levels. There have been pockets of shorts into many of these names and spaces, and every time in the last 1.5 odd month, we've seen every time there have been certain pockets of stocks and certain sectors which have been more favorite candidates for shorts. They are the ones which have been made to cover. And I believe Bank Nifty is the only index which I believe is remaining where you should see a strong bout of short covering, which could happen over the next couple of weeks. Now, in that regards, when you're expecting Bank Nifty to move up higher, you're of course expecting that the leaders on the banking side, and especially the private sector banks, they should move up significantly higher. So I think it's much more prudent that because we were expecting a start of a new rally, that you stand with the the leaders in that category. And I would probably expect ICICI Bank, Kotak Bank, from the large cap space specifically, could be the two names which you should look at. Even IndusInd Bank at current levels of 520, 530 zone, I think looks fairly attractive from a positional play as well. So I think it's better that you start investing into these kind of names. So South Indian Bank can also rally if the entire Bank Nifty rallies. But then I think there is always a huge amount of risk which is attached over here, as compared to maybe a moderate or a low risk which is attached to those large cap names. So I think it just about has to fit to the risk appetite of the investor. I would suggest large cap names like ICICI Bank and Kotak Bank, etc.
All right, Kunal, I think we got the point there. Gaurang, Kunal's allowed to give us a slightly more bullish view on South Indian Bank, given that he can refer to the chart. But from a fundamental standpoint, what would your advice be to Dilip?
Well, I definitely respect what Kunal has just mentioned a while back, but that is more on the technical front. On the fundamental side, I would beg to differ, Varun, and we in fact had a buy coverage which we have converted into a sell, given the huge disappointment on the earnings front and the way the stock has performed, not only in the last 5 months when your Nifty has recovered from the lows of 7,600 or thereabouts to 11,400 where we are. And during this 5-month period also, this bank has not done really much. And even before that, if you have to actually go to see 1 year, 2 year, 3 year, I think this has been a great disappointment for investors. And my humble request that don't look at the price and get into the stock either for trading or for investment purpose. You have to possibly reflect upon what the company or the bank is doing in terms of earnings, in terms of corporate management, in terms of growth visibility. And on all these parameters, I think this particular company is this bank is absolutely a no-no. I would say these are more suicidal tendencies, Varun, if you want to get into these kind of banks. There are better banks, as you rightly mentioned, and one of them, of course, is ICICI Bank that I spoke about. And in case if you're looking for a smaller bank, then I have two options from a long-term point of view. First one is Federal Bank, and the second one is IDFC First Bank. Of course, both these alternative investment idea, Varun, are from long-term. So you again need to have at least 1.5 to 2 year kind of time horizon.
Well, I hope Dilip has taken note of both the recommendations coming in. Of course, a tad bit different because, you know, it's like Dilip wanted a short-term as well as a long-term time horizon. Okay, let's take on board our next query. PK Swaminathan writes into us saying that he has bought 1,000 shares of PI Industries at 700 rupees in 2016. He wants to know a more short-term view. Well, he's already invested for 4 years, so I'm not sure why he would want a short-term view. But, you know, nevertheless, not sure if there's been any restructuring in the stock, but if not, he's sitting on great gains because the stock is just about nearing 2,000 rupees. In the last 1 to 2 odd months as well, we've seen massive momentum come by, you know, from those March lows of well, roughly about $1,000. It's gone up to 2,000 rupees. So first, Kunal, on the technicals and on the charts, how would you, you know, sort of, what would be your call on a PI?
Well, of course, I think, you know, as you rightly said, if you've held on for 4 years, then I don't see any reason why you should be looking to panic because you've bought at much, much lower levels than the stock is currently poised. But then, nevertheless, if you're looking for a shorter term view, then, you know, what I can see on the charts is, except for that period of Feb and March, where, you know, many of the stocks had seen a sharp correction, I think except for that period, if you look at the history, and I'm talking of at least the last 2.5 years of the chart pattern, there is this tendency of the stock to go into periods of rally, and then when it goes through a phase of correction, it tries to come back very close to its 50 DMA, you know, maybe in the band of 2%, 3%, 5% odd from that 50 DMA. So I think, you know, looking at that tendency of the stock price, where it moves up higher and then tries to, you know, go through a mean reversion process, the short-term charts could probably try and indicate you know, a similar kind of a perspective. Now, the stock is at 1960, 1965, if I'm not wrong, and the 200 DMA so far is placed at 1770 levels. And generally, when you see a convergence of sorts, it's possible that maybe somewhere closer to 1750, 1800 is where the stock could probably try and get back to a strong support level. So, purely as a short-term play, I believe 1800 is the 50 DMA, and the stock, looking at the tendency historically, has a, you know, a sort of a tendency to come back to its 50 DMA before restarting and resetting its uptrend.
All right. Well, there you have it. That's the word coming in from Kunal. You know, Gaurang, for all of our viewers who are interested in the fundamentals of PI Industries, let's get in your word as well. They recently had quite a successful QIP, which the management did say they want to use for, you know, inorganic opportunities. Plus, not to mention, of course, they are also in the midst of developing a COVID intermediate. How would you look at PI Industries at 2,000 rupees currently? Do you see more room for an up move?
So, Mubina, this is one of the picks in terms of specialty chemicals, and given the fact that with the kind of policy decision changes that the government has made in terms of the bilateral trade relationship with China and the kind of headwinds for China in terms of their companies able to cater to the world, Indian-based specialty and chemical companies can possibly outperform, taking opportunity of this big, you know, policy decision change that the government has put in place. Now, just to clarify your statement, even I don't think that there has been any corporate development, either in terms of some kind of a split or a bonus, etc. in the last couple of months. At least that is what I am given to understand. And from 700 rupees, I think the stock made a high of 2100 plus. So purely looking at the kind of returns that this investor is making, first of all, let me secure his capital. So I would advise him to at least book some part profit, bring home your capital, and add another 15-20% of your profit and sell only that many number of shares. By the virtue of doing this, your balance shares will be absolutely of no cost, and you will have possibly peaceful sleep at night in case if the markets or this particular company or sector has to correct. And more importantly, I was also listening into the management commentary, Mubina, and they sounded extremely confident in terms of the opportunities that lies ahead and the success they've made in terms of garnering funds for different kind of acquisitions that they want to do going forward. So stay invested, but given the investment level and the current market price, at least bring home your capital and maybe 15-20% and stay invested in the balance with the zero cost.
Okay, great. That's some prudent advice coming in for our investor. Just make sure that you book out your whatever you invested, and then the rest can ride for free. That's what Gaurav has to say. Sorry, excuse me. So I hope that addresses the PI industry's query sufficiently, and with that, we've come to the end of our query section. So thank you, Gaurang and Kunal, both. Great to have you on the show, as always. We're now going to switch gears a little bit. Earlier this morning, we spoke to Rohit Gupta, Chief Financial Officer at Zee Entertainment, regarding the recoveries in Q1, ad revenues, and outlook ahead. Let's listen in.
Well, frankly, Q1 is, even when we spoke last, I did mention to you that, Q1, there will be a significant impact of the lockdown on our ad revenues. And, so that was something we were expecting. Like I said, we are already seeing green shoots. We are already seeing, advertisers now coming back. There is a significant increase in July and August as we speak. However, if you see, the full growth will come back from Q3. So H2, we are expecting that H2 ad revenues will be higher than last year. So subscription revenues have remained resilient, both on TV and digital. And, we had a 6.2% growth in this quarter. We expect that subscription revenues will be strong. And for the full year, we will be showing growth in subscription revenues.
Okay, that was some interesting insights from the Zee management, and that counter seems to be fairly active today. On that note, let's slip into a quick break here on Buy Now, Sell Now. Plenty lined up when we come back.
Hi everyone, welcome back. You're watching the Buy Now, Sell Now on ET Now. Bank of America Securities conducted a survey of some of the topmost fund managers, and here are the takeaways. Firstly, this rally that we witnessed in the equity markets is not a bear market rally. There certainly seems to be some underlying strength in the equity markets, which does lead them to believe that perhaps there will be some semblance of sustenance in the up move that we have witnessed in the equity markets, although they do have some doubts emerging over the massive gold rally that we witnessed not just in 2020 but since the last 1 odd year. The equity allocation is higher by 7% from the last month, perhaps on the back of the fact that investors are expecting higher growth. The vaccine announcement is expected in early 2021, and thus conviction around a stronger economy is picking up. Asset allocation is thus accordingly skewed towards US growth stocks. Okay, well, moving on. Yesterday on the Money Show, we spoke about a concept of crafting your own stimulus check, especially, of course, for many US citizens and many citizens around the globe. They're waiting for when their government will give them some sort of stimulus check or some sort of money in their bank account, just so that they can get tied through this crisis. But, well, we shared with you a strategy on how you can create your own stimulus checks by 2 ways. Firstly, supplementing your main stream of income with a second stream of income, and secondly, creating an emergency fund. Listen in.
It was anyways happening. COVID was just a catalyst to make you realize that you need an alternative sources of income now. If you look at the way the things have changing on the work front, the jobs are now not as long lasting as they used to be 10, 15, 20 years ago. And the incomes have gone up very high. So if you have a solid career built already, you might be making a lot of good money quite early in your life. So having gone through those changes in the workplace environment and also the ability of individuals to pursue their passion, it has become all the more necessary to set up a passive income portfolio. That's what we call it in the financial advisory parlance, or something that can be turned on to be your cash register in case there is a loss of job. So changing times and the changing lifestyle and COVID, all three things made it very important for individuals to start seriously thinking about the alternative sources of income. So I would say it's a gradual transition which is happening in the way the industry and the people and the lifestyle is shaping up. And COVID was just a catalyst to make you realize that faster.
You know, Amit, it would perhaps be easier to say that, yes, maybe you should have a second income stream or a passive income stream. But Amit, realistically, I mean, you know, when you think of a second income stream, the first thing you think of is, you know, a rental income. You know, you put a property out on rent and extra property. But of course, maybe a lot of our viewers still are living on rent themselves. Forget about having an extra property to give out. So if you could just, you know, share some simple examples on how this passive income stream could be generated.
Sure. See, rental income or income from a business, all these are taxable and they are basically having a higher rate of income tax on it. But if you have your corpus accumulated in debt funds, you might achieve some tax efficiency. And if your job is already going on really well and you want to be prepared, you know, for any contingent times, then you don't need to withdraw. In other words, you don't need to have the secondary source of income. You can just let that corpus flow in a tax efficient manner. And if the need arises that you leave your job or your job is gone because of some unforeseen circumstances, then you can turn the tap on to start giving you the monthly cash flow, which may become tax efficient if you have been contributing for more than 3-4 years. So you do have multiple options. You can buy debt funds. You can buy real estate to have rental income. You can buy bonds to have a regular guaranteed income. You can buy some products of LIC, which are pension plans, which can start giving you pension. So you do have multiple sources. And if you can also leverage some of the senior citizen products, which are applicable only for people who are more than 60, then you do have some additional products like senior citizen savings scheme. You have LIC Bandhan Yojana. You can buy RBI savings bond, which have come last month. So there are multiple options that you can explore to have that secondary sources of income. But my recommendation is that if you do have a primary line of income coming, which is on, then you don't need to have a taxable secondary source of income. You can let that money grow in a tax efficient manner so that when you withdraw it 3, 4, or 5 years later, it saves you a lot from taxes, and it becomes a more of a compounding benefit coming to you due to your tax-efficient accumulation of corpus.
Okay, that was a really interesting excerpt from a conversation Mobina had earlier on. But let's switch gears a little bit back to the cabinet meeting Nayantara was telling us about earlier. The cabinet will convene shortly to take up crucial decisions regarding sugar, defense, and civil aviation. So the agenda before the cabinet for this meeting is important issues relating to defense, aviation and sugar, airport privatization and power sector reforms as well, like have been spoken about, food ministry as well featuring, and a possible hike in the FRP to 285 rupees per quintal from the current 275 rupees per quintal. Also, the MSP for sugarcane is another item that could come up for discussion. Also, Guwahati, Jaipur and Trivandrum airports are to be given on a lease basis. And finally, they're likely to consider corporatization of ordnance factories as well. So a lot that's going to be discussed, and we'll be bringing you the updates on that as and when we learn about them. But coming back to power, a little more focus there. Nayantara also spoke to RK Singh. Let's listen into that conversation.
The new tariff policy has been seen by the group of ministers. They have approved it.
It's been led by Mr. Amit Shah.
It was led by the defense minister. Mr. Amit Shah was a member, and all the senior ministers were members of that. So they've gone through it, they have approved it, and now it is before the cabinet. So hopefully the cabinet will take it up soon. Now the new distribution and new tariff policy has a number of reforms into it, and in fact these are reforms which have been talked about for a long time, which have in fact been mentioned in the law, but which somehow or the other could not get implemented. For example, let's talk about cross subsidy. Now the law says, and this law was passed in 2003, that the cross subsidies shall be reduced. Cross subsidy means when some consumer pays subsidy for some other consumer. That means the state wants to give power at a lower price to some category of consumers. So the state does not pay the subsidy. That subsidy is paid by other consumers. That burden is borne by other consumers. The Act says that that's not a proper way to do things. If the state government wants to subsidize a consumer, it should do so directly. But and the tariff policy of 2016 had said that the cross subsidy should be brought down to 20%. But that has not happened as yet. And the Niti Aayog has been writing to us for some time that because the cross subsidy has not come down and because the cross subsidy levels are very high, therefore the cost of manufacturing in India is uncompetitive. Because the power costs for industry are very high because of the high level of cross subsidy.
Well, moving on to yet another ET Now exclusive. Infosys co-founder Chris Gopalakrishnan, who is also a prolific investor in startups through Axeler Ventures, says that India's wealthy need to invest more in startups to buy innovation and opportunity. On the startup side, they must look at IPOs so that the Indian public benefits from wealth creation. He also defended his committee's decision to share non-personal data generated in India, even as the move has irked American internet giants. Here's the conversation he had with ET Now's Chandra Srikanth.
So this is clearly a mindset issue. I keep telling my colleagues in the industry that they need to think about it strategically. They need to think about investing in startups as a way to buy innovation into their own businesses, buy into the opportunity that India provides for growth, for wealth creation. So I have nothing against foreign capital coming in, and we need foreign capital to help India in its journey. But what happens is that when these companies become successful, let's say they do an exit, they do an IPO, the wealth gets distributed outside the country. The wealth does not get distributed in India. So we will be the loser. See, it is estimated that India's wealth is about $3 trillion in private hands, right? Only 1% or less is being invested in the startup sector, in startups in India. That's awfully low. From a family office perspective, from a personal point of view, I invest about 10 to 15% of my wealth into startups, right? And yes, the risk is more, but the reward once a while can be actually significantly higher than what you would make in other categories of investment. And that's the reason why I believe that you must invest in startups. Of course, the wealth creation opportunity for the country is significant. On the founders side, on the entrepreneurs side, I would suggest that some of them must look at IPOs. All right, very few of the startups, Indian startups, have done IPOs actually, and they should look at when they exit through an IPO, such that Indian public benefits from the wealth creation that the startups have done, rather than it being concentrated in the funds or a few individuals. So that's another way in which we can get Indian citizens to gain from the startup.
Okay, well, the talk of the town this morning, India Bulls Real Estate and Embassy, and the merger seems to have been shored up, and soon they should be trading as one combined entity. We're now going to be in conversation with a very special management, the man at the helm of this whole deal, Jeetu Virwani, who's the chairman and MD at Embassy Group. Good morning, sir. Welcome to the show. Thank you so much for taking up the time to chat with us this morning. Let's begin with a congratulations to you, a hearty one at that, on this mega merger. Could you walk us through the deal contours, especially as you are now the promoter of a much larger entity with increased geographical presence as well? And what's next for Embassy Developments?
So basically, it was a strategic decision to merge these two companies. The promoters of India Bulls Real Estate were looking for an exit out of the real estate business, and we were looking at a listed platform together with one of our institutional investors. And this merger actually brings a lot of synergy to both companies and to the merged entity. At the end of it, it allows us to be in different regions of India. We were more Bangalore-centric, and now we have access to Mumbai, we have access to NCR, and these are the markets we would like to be in. And we just realized that the assets of both companies, if merged together, would really make a formidable real estate company. And at the end of the day, we being a very commercial-centric developer, and India Bulls being more residential, this gave us a good mix as far as residential and commercial is concerned. Because we also believe in the coming years, residential is going to be a really strong play in India as far as the real estate industry is concerned. So pretty much, it gives us this, like I said, a very good synergy in taking this company forward. Both the merged entity will, land up with a lot of surplus of finished inventory, which generate a lot of cash. And as all of you have seen that, the way of doing real estate business in the country has changed a little bit, and more so after COVID. And this will help us to get into new areas in a much stronger manner with a stronger equity base.
Okay, so great. Thank you for spelling that out for us. But in the new and final entity, just for the sake of our viewers, what are the total assets under consideration if I include both the residential and the commercial portfolio? And secondly, are you planning a shift of any of these assets immediately to the Embassy Office REIT?
Not as now, because as you're aware that the merged entity will be only fructify at the end of about let's say about 8 months, 8 to 10 months, when all the formalities are complete. And as and when the opportunity arises, we would see it into the REIT. And that's pretty much the whole idea, that to have a listed development platform which will allow us to create commercial assets which we would seed into the REIT. So that's pretty much the whole idea of setting up the REIT and running a traditional business was that all our commercial assets will ultimately get seeded into the REIT. So this makes the REIT also a very strong play.
All right. Hi, Mr. Virwani. This is Mubina as well, joining into the conversation. I want to understand if Embassy is also planning to, move into and grow rather in the residential space. And if yes, which geographies do you want to focus in on?
So we would stick to the geographies of the merged entity. We're really not looking at any other region besides where both the companies are already in. And we would, the whole concept would be to complete all the residential these two companies have. Most of India Bulls assets are nearly about 80% complete, and most of the residential assets of Embassy are nearly like 95% complete. So the whole idea is to finish this inventory and sell them and raise cash to expand further. That's primarily the whole objective of the company. And in terms of finances, there's very little required. It might be surprising to you, but that we don't need to sell more than like 250 crores worth inventory to actually have a completed inventory of over 10,000 crores. So, let's make a company in a strong position.
So the India Bulls Group still has, roughly a close to 10% stake in the combined entity. Are there any timelines kept in place for their exit from the entity? And would you perhaps look at purchasing the stake that they own?
I don't know what their views are, but right now they're going to be below 10%. and then Momo will be the promoters of the new entity, and Embassy will be the promoter of the company. But in the long run, I really can't say. I mean, if we would buy or they would sell in the market, I mean, it's really nothing is planned as now. But they might just be staying there to benefit from the growth of this company. So, I mean, right now, there's no such decision taken.
Right, Mr. Virwani, and could you also talk to us about the role that you expect Blackstone to play in the new entity, and given that they have been partners of yours for a long time?
So that really hasn't been communicated, but as you're aware that we've declared that they've signed a non-binding LOI, and probably in the next few weeks, all the documentation would hopefully get completed. And then we will announce. But yeah, there is a strong partnership between Blackstone and Embassy, as you've seen with the REIT. And this was, an idea to, again, like I said, build a development platform, mainly as far as the commercial assets is concerned, to seed into the REIT. So going forward, yeah, but we'll let you know that in the next few weeks.
All right, so and finally from us this morning, a bit of a touchy subject. What will be the total debt on the books of the combined entity, firstly? Secondly, what will be Indiabulls' portion specifically of that debt? How do you intend to repay, especially given that the climate has worsened considerably over the last half year or so?
So I think the combined debt will be close to about 4,600 or close to 5,000. I'm not sure the exact number, but the fact is that we have all ready inventory. So the whole idea, like I said, is to sell that and pay down the debt as the sales come into play. So as of now, we don't have any immediate liquidity issues in both these companies. So I don't think that should be a problem. And like I just said, that the sales receivables of all the goods which are sold are quite high. I mean, combinedly, it's like I think close to about 4,600 crores, or in excess of that. And right now, like I said, just the receivables from the company is in excess of about 4,000 crores. And once we complete them, we'll have immediate ready inventory of close to about 10,000 and 6,000 odd crores being immediate. So I don't think that the whole idea was actually to build a stronger company in terms of liquidity, as we see in our industry across, most developers are have liquidity issues, and that being the major objective of combining these two entities. So we don't see anything. I think we see a much stronger company in terms of cash flow wise.
Okay, well, Mr. Virwani, thank you for joining us today on ET Now to talk about, finally, that the deal is done. IB Realty and Embassy Group have finalized the merger terms. The residential and commercial projects will be merged. For now, IB Realty still has roughly about a 10% stake in the company. Okay, well, meantime, after President Donald Trump virtually banned the popular short video app TikTok in the United States, several companies have stepped up to throw their hat in the ring to acquire or crack some kind of deal. But it has to be done by the 15th of September. That's when Trump's 90-day deadline ends. So which are the companies in the running, and what really is at stake here? Vikram Oza joins us to put it all into perspective.
Yes, ever since the Trump administration has virtually banned TikTok in the United States, the suitors have been lining up. But just to understand where ByteDance is coming from, it was a company founded in Beijing in China in the year 2012. TikTok came into existence in 2017. But when it comes to ByteDance as the parent company, they tried to distance themselves from the Chinese government by getting themselves incorporated in the Cayman Islands. In fact, subsidiaries of ByteDance, which control TikTok in the US, are also based in Cayman Islands. The one that was controlling the Indian operations were in Singapore. But when it comes to the suitors, Microsoft is at the top of the heap. And of course, they have the war chest for it. There's no taking away from that. But they want the entire TikTok operations, which could be a deal clincher. which is slightly different from what an Oracle is in it for, because they don't want the entire operations. They're looking for the US, Canada, New Zealand and Australia. And there are news reports that they have been in preliminary talks with ByteDance. Meanwhile, Twitter is also in the fray, which is slightly surprising because you remember they had Vine, which is quite similar to TikTok. That didn't succeed, and yet they want TikTok at this point in time, but they are talking about some kind of partnership deal. The word that is coming out in news reports is a potential combination with TikTok, so may not be a full-fledged acquisition. Also in the fray are Sequoia Capital and General Atlantic. You might remember in 2014, Sequoia had put in money into TikTok already. And meanwhile, as far as Indian operations are concerned, there is Reliance Jio, which is interested, $3 billion worth of a valuation for the Indian arm of TikTok. But when you talk about the global reach, the user base, India is the biggest. There's no taking away from that. But when it comes to the revenues, then it's the United States that turns it in for ByteDance through TikTok. And the total valuation globally for TikTok is supposed to be anywhere in the region of $50 billion. So big money is at stake. But there are challenges because, one, TikTok could be taking the Trump administration to court over this ban, the official ban after it kicks in on the 15th of September. And if it is the 15th of September, then time is also running out. So if Microsoft is going to come in, then perhaps they need more time to iron out the details and get all the financials right when it comes to this kind of deal. And thirdly, of course, you can't take away from the fact that there is competition that's biting at their heels. The social media behemoth Facebook has already rolled out Reels, and they are chipping away at that large user base that TikTok once commanded. So all of these possibilities, so many suitors, the time is ticking away for TikTok.
All right. That was, of course, Vikram Oza joining us with a very interesting report when it comes to what is the future of TikTok in the United States. All right. Well, with that, we're out of time on this episode of Buy Now, Sell Now. Many thanks for watching from Varun and me and the entire team that put this show together. Stay tuned for Markets at Noon.